When it comes to the ETFs, VOO and VTI, many think you can just flip a coin, choose whichever. But right now, there could be a valuation shift forming, putting one of these funds on track to perform better over the next 10 years. Today, we're going to be talking about that hidden factor. Drop a heart in the chat if you already own one of these two ETFs. First, VOO. It's a way of buying about 500 of the biggest and strongest companies in America, giants like Apple, Microsoft, and NVIDIA. VTI, the Vanguard Total Stock Market ETF, is like buying every American company, 3,503 of them. All those big names, plus thousands of medium and small companies. Both are excellent choices, but today we're going to look at why VTI might have an edge over the next decade and why VOO will still remain strong. Here's why a lot of people believe that VTI could do better over the long run. Those really big companies that are leading both of these funds have had an amazing run because of AI, because of those Mag 7 companies. When it comes to VOO, for example, those top companies make up a little bit over 38% of the fund, making it the most top-heavy that it's been in history. So if 3 or 4 of those tech giants slow down or have a bad year, this fund will be heavily impacted. Meanwhile, those medium and small companies inside of VTI are trading at lower prices. One recent study showed that big companies are currently priced at a premium, making them more expensive relative to the profits that they generate, while some smaller companies are trading at a noticeable discount, giving them more room for potential growth if their earnings pick up. So essentially, investors are paying more for a dollar of profit from those large companies right now, as opposed to those smaller ones. Basically, there are many small companies on sale right now. And as they grow in size, this helps VTI to be set up nicely to capture those gains. So VTI is a fund that I hold in multiple portfolios, but I hold S&P 500 investments in multiple also. But when it comes to VTI, I did an over 3-year stretch of investing $10 daily because I liked what this fund offered. Exposure to the total U.S. stock market. Both have the same expense ratio of 0.03%. So low fees, diversification, steady growth, steady dividends, stability to pair with those individual companies that I also incorporate. So keep the comments coming. Are you S&P 500, total U.S. stock market, or both? Which funds give you exposure? So I'm definitely not saying the run is done when it comes to these big companies. They are still growing, but there are many medium and small companies on track to grow their profits faster than the mega cap names leading these funds. And so VTI owns those companies, already perfectly positioned to capture that growth. Nothing is guaranteed. You won't go wrong with choosing either of these funds. Companies across the board are focusing on AI, and those larger companies are usually more self-sufficient, not needing to borrow cash, while those smaller companies do. And so higher interest rates could be a factor that could slow them down, making things a bit tougher for them. But if we start to get some interest rate cuts, those companies in VTI could better handle that debt. Both of these funds hit all-time highs. They both recover after those tough times because you're not just betting on one company. You're betting on hundreds, with VTI thousands. So if you think that those smaller companies are on track to have their moment, to really start to increase in size, VTI or another low-cost fund that gives exposure to the total U.S. stock market could be your best bet for a long-term hold. But don't get overly stressed. It's not about picking the perfect fund. These are both good investment choices that you can hold long-term, allowing them to build and grow. Keep on adding to it. Stay invested for the long term. Reinvest those dividends. You will be on track for steady growth. So, taking a look at the performance of these two funds on some shorter time frames, over the last 6 months, VTI is up 11.44%, while VOO is up 11.34%. Neck and neck, VTI slightly higher. Year to date, same. VTI just a little bit higher, and the same over the last year. VTI up 30.35%, while VOO was up 30.28%. But then zooming out to a further time frame, we can see that VOO is up about 93%, while VTI is up 83%. So these two ETFs have an 88% overlap, but that 12% can make a difference. Even taking into consideration companies that Trump has been trading this year. He's made 3,600 transactions. A significant amount are into those mega cap companies, but there's also small and mid cap names like Mara, MicroStrategy. So I hold both. Even my daughter has a few shares in her portfolio. When it comes to VTI, she's up 80.38% and I'm up 68.66%. But neither one, the S&P 500 or the total US stock market, has disappointed. So long term, the shift may just be the difference it is now, where VOO usually outperforms by less than 2%. It could shift to VTI being the leader. Let me know your thoughts. Which are you leaning towards? Always remember, consistency is key. Always think long term. In 10 years, for many of us, is not the end of our investing journey. So don't be obsessed about short time frames. Make sure you're staying on track for long-term growth. Thanks for watching. Okay, bye.